All right, looks like we're live. Welcome everybody to Live Valuation. I'm Minus Moriarty, and today we're going to be taking a look at ticker TROW, T Rowe Price. Pretty interesting and very cheap looking asset manager. Very excited to get into it. Sorry, kind of distracted there for a second. This one's been requested for quite some time by several viewers of the channel and members of the Discord, so I'm definitely been kind of looking forward to getting around to this for some time. It's looked pretty attractive, just so many other companies to look at. Here, taking a look at our watch list, there's been some interesting moves in a few different companies. What with the readjustment to our risk measure that I discussed changing at the beginning of last week, there's obviously just been some general movements in the positions of them based off of that, like a few of the other companies that were not looking as attractive, like for example LPX is looking a little bit better with the new risk measure compared to the old one. There's been interesting moves in the retailers that I personally own, such as Hibbett and Buckle. Today I noticed both of them had pretty sharp jumps. I haven't looked in to see if there's some specific reasons why those retailers are jumping today, but interesting movements nonetheless. But then I am very interested in TROW, the company that we're going to be valuing today, which, because I guess I'll just say it right off the bat, the valuation looks very, very good. And so I'm very interested in doing much more research even after the evaluation of today, because while I do have a valuation that I'm presenting today, it is relatively simple, I would say, a very simple kind of top-down valuation that a lot more background research would be merited, definitely, before making any sort of investment in the company, because it being an asset manager, it has its hooks and fingers in a lot of little different nooks and crannies of types of businesses. And so even though I've read through their 10K once already, I feel like I would need to read through it a little bit more to be 100%. And I'm almost looking for feedback on today's valuation to get an idea of whether or not I'm missing something, so to speak, in my numbers. Before we get into that, though, there was also some economic news that came out today. They released new housing start information as well as industrial production numbers. The industrial production numbers were relatively good, as was generally expected, and the housing start numbers were relatively bad, as was expected. The market is up pretty good today regardless of that. If we come over here to the Federal Reserve website and take a look at the total units of privately owned housing unit starts, you can see that this is kind of the long-term cycle since 1959. We come in for the last 10 years, you can see that this is kind of the upward boom in housing starts that we've had, although as we can see, it's still relatively low compared to some of the peak years that we've had. But in the most recent month, you can see it's a pretty sharp decline downward from around 1600 to 1450 or so, in that kind of ballpark. So there's a decent amount of downward movement. This is kind of the expected downward movement in housing starts. This being caused by the upward pressure in interest rates and how that moves mortgage rates upward. But the point is, I'm trying to show that it's not necessarily moved down that much compared to the long-term cycle. In fact, I actually pulled open a spreadsheet to kind of take a look at all that data to get an idea, like, well, what is the actual typical numbers like for this? So the long-term average, meaning from 1959, the entire data set we have, the average monthly housing starts is 1434, which we're kind of hovering just above that mark already right now. The average during the 70s and 80s, which is the period in which we had high inflation and rising interest rates, it was around 1600 during that period, so even higher. They managed to actually have good housing starts during high inflation, high interest rates periods. And then since 83, which is the period since inflation had been, so to speak, conquered, and then in the paradigm we've lived, it's been more like 1377. So we're above average based off of that metric a little bit. And then the medians for those same periods. And then I also went and captured the first quartile of those periods to get an idea that if housing starts are to keep coming down, where would be an area that it would have to reach to perhaps reach some sort of point where we could say that it's actually perhaps starting to bottom. Though obviously, if you come back over to here, you can see that the actual bottoms in the various cycles often reached triple digits rather than quadruple digits at various points. So that's not to say that that is necessarily a bottom. It's just to say, like, at what point would you have to reach to perhaps argue that maybe we're getting to sort of that kind of bottom. And across those varying time periods, it's more like 1200, 1100, 1200, kind of in that range. So just an interesting kind of thought experiment I was running going over the housing starts today, which is to say that, yeah, there's a big decline in the most recent month, but I definitely think it's actually relatively good still. I think the housing market is actually being relatively resilient compared to general concerns that could be had for that. So with that, we'll get into the actual valuation for TROW. Before we get into that, I will cover some company specific information as we typically have been doing at the start of our valuations. Though before I get into that, I would ask those who are watching to please give us a like. I see we already have a couple of likes and a few viewers already. Very much appreciated. If you're watching on replay, please also give us a like. If you're not already subscribed, please subscribe to the channel. That way you can get notifications when I go live and whenever I release other content, as well as the pinned comment in the chat, as well as in the description below is the link to the Discord. Join the Discord so you can join our conversations about the market, portfolios, company analysis, and things like that. So anyway, getting into TROW price, they were founded in 1937 in United States company, entirely USD. Nukit, hey, welcome to the chat. I saw you joined. Anyway, I have their links to the main sites, their investor relations, and the SEC page here. Their new and most recent CEO, Robert Sharps, he literally was just made CEO. They just had a changeover of their CEOs, which I'll show that actually in the presentation when I show a few details from that in a moment. So elected in 2022. He did, however, join TROW in 1997, so he's been around for quite a long time, head of investments there. As we already said, industry, they're in the asset management industry. Customers and suppliers, not really super relevant concept for them. They have many customers, but top competitors, it's pretty varied into what you could count as a competitor for them. I put BlackRock, Morgan Stanley, UBS, and IBC up here, but definitely lots of other companies you can consider. I'm gonna watch the replay later on. Thanks for the video. Keep up the good work. Thanks, Nukit. Always appreciate your support. Anyway, they are reporting next a special reporting date on September 15th. I saw that on their website that they have a special meeting announced for that. I'm not entirely sure what that's going to be about, though I think they had some special transactions planned for later this year, so that may be related to a transaction or something like that, but that's partially just my speculation. They actually did only not too long ago have an actual call, which was a couple of weeks ago, so that's kind of why I'm only listing that there to kind of point out that this special call is a bit of an offbeat call from their normal cycle. I don't have specific guidance numbers from them. I didn't really find that in their reports too specifically, but there is revenue analyst guidance off of Yahoo. 6 analysts are guiding about a 14% decline in revenues in this particular year, and then expected approximately flat or so for the next year. Another 6 analysts projecting that there. They have $7.32 for their trailing 12-month dividend, versus $4.56 on the current forward expected. They did have a special dividend most recently, so the current forward dividend being $3.45%. I mean, and then also there is approximately 11.7 million shares of buyback authorized. They had 15 million or so, and then in their most recent quarterly call, their release implies that they had purchased 3.8 million. So it's something around 12 million or so shares still authorized for their repurchase, which equates to about 1.5 billion or 5%. So between the dividend and the buyback, there's about 8 to 9% in total if they were to use it in 1 year expected. Total insider holdings ownership is about 1.93%, and in the last 6 months it has increased, but just barely, about 1.7%. Nothing too major in inside buying, but there is some inside buying. It pretty majorly held by institutions, about 75 to 76%, which is definitely not to be too big of a surprise considering it's a pretty large market cap and it's a major asset manager. So institutions owning other institutions, so to speak. About 7.5% of the outstanding shares are currently being shorted, which is pretty similar to the amount off of the float, because as we had said, it's a pretty large and liquid stock. So the overall market cap versus the float is not too different. Current short ratio about 10.6, so a pretty large short ratio, no real pressure on the short sellers to cover any time in the near future. 3-month average volume being pretty similar also to the 10-day average volume, so pretty consistent ebb and flow, at least in the most recent few months or so. So getting over into the well, this is actually the earnings release, but I guess I'll point out one thing on here, which is this is going to be relevant to some of the details I use for my projections of revenue, which not really too much of it, just talking about the fact that they list their most recent assets under management here, and pointing out that based off the most recent quarters, they're currently down on assets under management about 10% year to date. So that's going to be relevant for our projections later. But coming over also to this presentation that they had for a a special event a couple months back. Here shows major members of their management. This is the new CEO here, Rob Sharps, who was replacing this fellow here, Bill Stromberg. So you can see here, much younger looking, spry gentleman. Hopefully he'll be around for a while. As we already said, he's been with the company since 1997, so I guess he theoretically could. Only other thing I was going to kind of really show in the presentation here is just kind of the disbursement of their capital under management by geography, as they show here: North America versus Middle East and Austria, Asia, which this is really just by investor by domicile, so it's not actually relevant to necessarily the recognition of the revenues, which is relevant to the equity risk premium I'm using. So I'm actually not judging their revenues under a different geography based purpose, but it does equate over to the different capital, approximately like who actually owns the capital. The capital is domiciled in the United States when it's being held, but these are the people who actually own it. Kind of complicated to say. But either way, also then showing the different types of capital under management by type, showing that 58% of their capital under management is actually held by pensions, which is pretty important to show the ways in which I'm going to be projecting their numbers compared to, like, for example, Invesco, another company asset manager that I valued semi recently, where I was using a little bit more of a volatile method for deciding how I'm going to project the revenues. I'm going to use a little bit more of a stable, longer term approach for TROW, based off of the fact that they have a much larger percentage of their overall capital base with larger institutions like pensions and sovereign wealth funds and things like that, which have a little bit more of a steady approach to asset and capital management. So coming over here to the actual valuation, here, hold on, actually 1 second, I need to get one quick little thing where I actually pull that up. Hold on a second. Here. Sorry. Okay, so here's my projections for TROW price, and we will start down at the segmentation as we usually do. They are being classified entirely as an asset manager, and in that particular group I have an unlevered beta of 0.83, with that a sales to capital of 0.61 and a net margin of 15.93. So pretty low sales to capital ratio, which is pretty typical for asset managers or other financial institutions. There's a large capital base relative to their overall sales base, because they have to have a large amount of clients in order to get relatively small amounts of fees. But because those fees make up essentially the revenues and not really their actual profits, they typically have relatively small operational costs, and they can typically get relatively high margins to back that up. As I was just saying, with the disbursement of their revenues geographically, they show the different capital assets as being domiciled in different areas. I'm using just the international equity risk premium of 5.26 for the company, just across the board for them, and that in general, after applying the leverage to the unlevered beta, which they basically have no major leverage, so they basically, their unlevered beta goes from 0.83 to 0.84. That leaves the total risk premium at 5.48, and that brings the cost of equity to 8.29%. And so with that, the cost of capital is 8.24%, because their cost of capital and the weighted average cost of equity are going to be basically the same due to the fact that they have no real leverage. They do have a small amount of leverage. It's just about 250 million or so in lease liabilities, but comparing that to their market cap of 30 billion, that means that it's less than 1%. So their cost of capital and their cost of equity are going to be approximately the same. So with that, we can come over to their financial history and take a look at that. From 2012 up through 2021, they had sales of 3 billion going up to 7.6 billion. So moving at pretty steady high single digits for rolling 5-year periods up through 2020, and then it spikes up pretty significantly due to a 23% increase in sales in 2021. So pretty dramatic increase in sales, but before that they were kind of consistently growing at a pretty steady 8.5% or so on compounded 5-year rolling periods. You can see also that their gross margins have been pretty consistent. There was a more of a closer to 60% average for the first 5 years. You see 61% actually, and then it kind of dipped down a little bit towards the upper 50s, 57% up through 2020, and then that spiked up back up to around 60 to 61% in 2021. I don't actually see too many specific reasons through their cash flow statement, which is usually where I look for reasons why margins have changed over time, either by looking at the types of investment that occurred through specific years or things like that. But there isn't necessarily major acquisitions in any particular year. It's really just small incremental changes to it as they've grown over time. So I can't necessarily say that this change in margin is something that was, I guess, structural, and it could just be a little bit more of an ebb and flow of their business. If you include 2021, the long-term average of it is 59, close to 60%, pretty consistently across the board. So overall, I would say that margin, you could basically expect it to stay pretty consistent. In fact, if anything was to explain the decrease in gross margin, it might have to do with really just overall pressure on the fee structure during the overall bull market as it continued through the cycle. So as we eventually hit more volatile parts of the market in 2020 and 2021, perhaps that left a little bit more profitability for them in the channel in the short run. That's just my kind of short-term theory on that. Taking a look at their net margins, you can see for the first 5 years of the period, they had net margins averaging about 29%, and for the next 5 years, it averages 35%. So there is a pretty consistent increase in the net margin over the 10-year period. That having to do, I think, with just overall economies of scale with their type of business model in general. There is generally really low operational costs and SG&A costs for this type of business structure. So that actually just makes sense to me. Like I said, I would expect to see their gross margins actually decrease over time as they increase in scale, and perhaps have their net margins increase as a result of that. So coming down to the cash flow line and taking a look at their cash flows to equity compared to the amounts that they paid out to their shareholders. For the first 5 years of their business, they averaged about 795 million, close to 800 million that they could have paid out to their shareholders. That's free cash flow to equity. So free cash flow, and then after adjusting for their net inflows to debt and also share issuances, that's the amount of money they theoretically could have paid out to their shareholders during those 5 years. And then on average, the amount that they did pay out to their shareholders was about $1 billion. So they were overpaying their shareholders for the first 5 years of this historic period. For the next 5 years of the historic period, they averaged a little over 1,100 million, 1.1 billion or so that they could have paid out to shareholders per year. And the amount that they did pay out to the shareholders during this time period was 1.8 billion. So they do have a pretty consistent record of overpaying their shareholders according to the way that I calculate it. That's not exactly super great. But that comes down to a few other factors, whether or not that's necessarily an ultimate detriment to the company. That does kind of disqualify them from getting an ultra high qualitative rating from my own personal way of liking to rank companies, because that's kind of an important thing for me to make sure companies aren't overpaying. But we will take a look at the balance sheet to see whether or not that's actually being a problem for them. You could argue that they had large amounts of cash always built up from the get-go, and that this is them kind of just slowly flushing cash out of their business. And also it's worth noting that this free cash flow to equity line is net of all forms of capital expenditures, including acquisitions. And you can see there is a really large acquisition that they had, 2.4 billion in 2021. And so I don't know, perhaps maybe if you just completely discounted the 2.4 billion there, the 5-year average here would probably be dramatically higher, the amount that they could have paid out to their shareholders. So if not for one acquisition, this most recent 5-year period may actually have been pretty all right as far as paying out to their shareholders. That doesn't make up for, like I said, the first 5 years they were also overpaying. But just my thoughts on total shareholders payouts. They seem to be very, very interested in making large payouts to their shareholders, but perhaps maybe they should slow it down a little bit. Coming down to the returns on invested capital, you can see that they do have very, very strong returns on invested capital for the last 5 years, or for the first 5 years in our historic period. They averaged about 27%. For the next 5 years, they averaged about 26%. So pretty consistent. It's technically moved downward a little bit over the period, but staying in this kind of consistent mid-20s range as far as returns on invested capital, which is pretty excellent, especially for a company of this scale. Special divvy. Yeah, we talked about the special divvy that they paid most recently a little bit earlier. Thank you for noting that. Welcome to the stream. Give us a like if you haven't already. Much appreciated. Also, looking at the returns on equity, you can see that the returns on equity are pretty much equivalent with the returns on invested capital, partially because they're not really using any leverage, which, I mean, because of the fact that they have such strong returns on invested capital, you can argue they don't really need leverage. Mid-20s and consistently mid-20s is pretty excellent. So I guess no real problem there. But at the same time, you know, the whole point of having equity versus other types of capital is that you can leverage it into higher returns. So you could argue that maybe with a small amount of leverage, maybe up to 10% or something like that, they could perhaps boost it into more solidly into the 30s or something. Not necessarily a management recommendation for them. But either way, so now taking a look at the balance sheet, and this will get into some of the things I was saying about their share buybacks and large dividend payments and whether or not that's actually a problem. We'll kind of take a look at that together and see what we think. Taking a look at their overall cash levels, you can see obviously going from 879 million to an average of 1.2 billion for the first 5 years, and then ending at 1.5 billion in the most recent year, and averaging about 1.7 billion during those 5 years or so. So pretty consistent growth in the overall amount of cash that's being held in the business. Whether or not that's large in scale relative to other parts of the balance sheet is another question, but you can't say that they're exactly lacking for cash. So regardless of the amounts that they paid out to the shareholders, the accounts receivable has also grown pretty consistently over the period, averaging 450 or so million for the first 5 years, and then averaging more like 760 million for the next 5 years, ending at 1 billion or so in the most recent period. So very consistent growth in receivables, which is good. That's liquidity for a company, but you don't necessarily want to see receivables grow too fast, and that of course is really just bouncing it off against the accounts payable. You always want your receivables to be more than your accounts payable, in my opinion, but you don't necessarily want your receivables to be too much more, because essentially it's just like money that it's cash that you don't have yet. So if your receivables growing too much, that's a problem. Their payables averaged 166 million for the first 5 years, and then averaged a little under 300 million for the next 5 years. So while there has been growth in the payables, there's actually been a much larger growth in the receivables, which, as I said, you could argue that maybe they should be trying to collect these bills a little bit more. Not necessarily a problem, but maybe that's part of the reason they feel like they can pay out excess dividends to the shareholders. Maybe they're counting some of their receivable chickens before they hatch, so to speak. Not necessarily, just taking thought experiment, thinking about things. Overall current assets, 1.7 billion for the first 5 years, versus 1.2 or 2.5 billion for the next 5 years, which is pretty close to where it ended for the last period. That also is pretty strong relative to the current liabilities. Though I would show that actually the current liabilities in total have actually exploded in size from an average of close to 300 million for the first 5 years to about 1 billion or so in average for the next 5 years, ending 1.6 billion. So there actually has been a pretty dramatic growth in the total current liabilities. It's just mostly stuffed in this other current liabilities category, which might include a few items that I stacked together. I can't remember what it actually includes. Maybe might be some deferred revenues, maybe some deferred taxes or something like that. But either way, it's not payables and not current debt, whatever the other items in there is. So total assets, however, if we do take a look at that went from 4 billion for the first year, averaging 5.2 billion the first 5 years, to averaging 9.5 billion in the next 5 years and ending 12.5 billion. So very large growth in total assets, tripling over the extended period. The amount of the total liabilities growing over that same period also exploded, but exploded much more than the assets. So going from around 350 million to 2.2 billion. So whereas the assets really only tripled during this period, the total liabilities have absolutely exploded. What is that, an 8x or so? 7 or 8x approximately. So yeah, a much larger growth in liabilities. So the question is whether or not that affected their shareholders' equity statement in a negative way, because obviously the shareholders' equity is going to have the leveraging effects between the two other parts of the statement. So, I mean, shareholders' equity going from 3.8 billion, averaging 4.7 billion for the first 5 years, to 7.1 billion, ending 9 billion. That doesn't include the non-controlling interests. So yeah, their shareholders' equity more than doubled on, or approximately doubled on an average basis, and close to tripled over the entire time frame. But that's definitely not nearly as fast as the growth in liabilities. It's not as fast as the growth in assets either. So I would say that out of the three statements, their equity statement is actually the slowest growing of the three, which means to me that they're kind of in a state of paying back capital to shareholders, which is shown by the fact that they are overpaying also their overall cash flow. So and then the one last detail that kind of puts that thought to complete is taking a look at the actual portion of the shareholders' equity statement that is the retained earnings, because that's kind of netted of the cancellation of treasury. So we have 3 billion or so at the first start, averaging about 3.8 billion for the first 5 years, averaging 6.4 billion for the next 5 years, and then ending at about 8 billion. So they did grow their retained earnings regardless of all those factors. So while they are overpaying their shareholders or on 5 and 10 year periods, it looks to me like it's actually a relatively close controlled liquidation of excess equity within the business, because they while, like I said, they've been growing their liabilities much larger, and partially the way in which they're growing their liabilities is they're taking on larger amounts of liabilities, or at least not paying their liabilities as fast, so that they can pay out those shareholder returns. But since, like I said, since the shareholders' equity is still growing, and the retained earnings is still growing, and the cash levels are still growing, and they still have more receivables and payables, it is hard to argue that it's actually a problem for their business. It does make me question my own interest in investing in them. Like I said, that does kind of disqualify them from getting certain high qualitative ratings, in my opinion. I don't like companies that overpay their shareholders too much. But it does mean that if you personally already own them, then I don't see any reason why you couldn't just continue to collect those returns. Jackass, the meme stock of value stocks. This one, TROW, is that what you're saying? Anyway, so we'll come down here to the sales capital ratio to kind of take a look at how that's evolved over time, and it has in fact evolved over time. You can see that for the first 5-year period of the projection period, it actually achieved just over 1 of a period. Yes, is it? I mean, I don't know. I haven't really heard that many people memeing about TROW, so maybe I'm just missing those circles, I guess. But enlighten me. You can see that it has consistently moved down over the 10-year period, averaging just over 1 for the first 5 years, and it was kind of just over 1 at the start, now down to below 1, which is a little bit more logical, I think, in terms of the type of business they're in, as we had kind of said at the start, balancing out the sales capital ratio with the net margins. They do have much higher net margins than the industrial grouping that they have, and their industrial grouping typically has decent margins and then low sales capital ratios. So the fact that they have pretty great margins generally would make me think that they would have an even lower sales capital ratio, because I would assume that they would be making large capital investments in order to essentially get the market share they have that allows them to keep those margins. But somehow they're actually flying the line pretty evenly between it, having not too terrible of a sales capital ratio while maintaining an exceptionally high net margin. So either way, for the last 3 years on average, it was 0.85. If you take a look at more of a longer term average, its approach is close to 1. If we come and actually take a look at the projections for the company, well, actually, before I do the projections for the sales capital ratio, I did build a revenue model for the actual growth of the revenue. So we'll do that part first. But anyway, so coming over to this page here to take a look at the projections I built for the revenue model. As I was saying, what I did is I went through a whole bunch of their annual statements and put together a time series here going back to 2007. 2007, this first line here, what we have is the assets under management for the company from 2007 up through to 2021. Now, the reason why I went back to 2007 specifically is because that was as far back as I had to go to find a large decline in their assets under management due to a large market crash. And they're currently having a pretty significant decline in their assets under management. Whether or not the year will end that way, because obviously, you know, plenty of people think that the market has already bottomed, and it very well might have. So this going back this far could be all for naught. And worst case scenario, it just means we're getting a really nice look at the way their company operates over a very long cycle, 15 years. So anyway, the point is, coming back to 2007, in 2008, you can see that the assets under management declined about 30% from here. And so what that gives me is a total CAGR for the growth of their assets under management, basically from peak to peak. And that's kind of what I wanted. So I wanted a peak to peak from market cycle. You could go from bottom to bottom in market cycle as well, but I don't really have the bottom yet, so to speak, that I know of. So that's part of the reason why I wanted peak to peak. So peak to peak, you can see the year-over-year changes underneath it. And then I actually have the cumulative CAGR in the line underneath it. So you can see it starts with the same number here, but as it goes, it actually includes both years and basically is a cumulative compounded growth rate from 2007 onward. So you can see how the actual CAGR of the assets under management grew throughout the entire time frame. And what we get to is that over the entire 15-year period, their assets under management grew at a CAGR of just under 11%, which is pretty astounding. That's relatively in line with the market growth itself. The market was a little bit hotter than that in actual returns, but getting assets under management pretty close in line with the market itself is pretty good. And then below that, I also have rolling 5-year periods. So starting with the first 5-year CAGR available, and then I actually have the 5-year CAGRs move forward with the overall time series. So you can see 5-year CAGRs over the entire 15-year period, going anywhere from as low as 7.5% to up to close to 16% if you had started in only the last 5 years. So just giving me kind of an idea of different ways in which their assets under management have shifted over a very long 15-year period. And then below that, we also have the revenue of the company itself. I only have the revenues of the company going back to 2012. I didn't really feel like going back further than that for this part of it. And then the net fee take is the line I have underneath that, which is essentially me taking the revenues and just dividing that into their assets under management. Their overall revenues as a percentage of their assets under management, we're going to call that their fee take. It's not necessarily equivalent to actual fees. They have other parts of their revenues, some sections of the revenues that aren't actually really equivalent with fees, but I'm just keeping it simple and putting revenues directly into our assets under management. And that's what I have for this line under here. You can see that over the entire time frame, it averages pretty close to about 50 basis points. It ebbs and flows a little bit. It starts off a little bit higher than 50 basis points. It has some higher points than 50 basis points, and then it goes below and ends below 50 basis points or so. But 50 basis points seems to be a pretty rough equivalent of the overall fee take that they had over this 15-year period. And then I also included the margins that they were able to achieve during this time frame. To kind of, I was trying to see if there was any trends I could find in the changes in their margins itself. So to get an idea of what I was going to project forward as far as for the revenues, I did build in the approximate 10% decline in assets under management they've already had over here. So I started with that. I didn't start with the 2021 assets under management. I started where approximately where we already are. And with that, I looked at the most recent 5-year CAGR, which was the 16%. That was the highest CAGR period they had, not counting kind of a weird fluke year that they had back where it spiked to 20% due to a basing effect. So I didn't really count that one. But the 16% or so as the highest period, to me, that looks like a good best case scenario for their assets under management. And worst case scenario, I decided to just use 0% from the basing, which I thought was a pretty bad worst case scenario. The idea that in 5 years time, they would have grown their assets under management 0. That implies to me that they would have a couple years of significant decline in assets under management, and then a few years of getting back to basically the same level. So again, we're talking about 2026 here. So assuming that in 2026, the revenues are exactly the same as a worst case scenario, not revenues, their assets under management are exactly the same. And then in the best case scenario, assuming that their assets under management grew 16% per year. So that gets me assets under management in 2026, worst case scenario of about 1.5 trillion, best case scenario 2.6 or 2.7 trillion. I can't even read numbers right there. So that's the baseline for how I came up with my worst and best case scenario assets under management. And then taking a look at, like I said, the averages of the basis points of the fee structure they had right here. Their fees decreased from a 5-year average to the next 5-year average about 10% or so over the 10-year period that I have here. And then I assume, well, in a worst case scenario, what if it did significantly more than that, and it actually did basically twice as much as that over another 5-year period? And then that would perhaps get them down to 29 basis points in a worst case scenario for 2026. In best case scenario, I assume that they would actually stay about the same. I don't really assume that they would actually grow their fees as a percentage of their assets under management over time, because in general, the market has been pushing fees down overall. So I don't really, and I think that that's partially where the decline in their overall fee take came from in the first place. So I don't actually see it going upward in the best case scenario. So I left it at the same as the most recent 5-year average, which is 48 basis points. So from 29 basis points to 48 basis points becomes the worst to best case scenarios for the overall fee take of the assets under management. And then with that, that gets me implied revenues of 4.4 billion in the worst case scenario to 13 billion in the best case scenario for 2026. So that's the projection I'm using for my revenues for TROW price, based off of, like I said, kind of a longer term analysis of their assets under management and their overall fees as a percentage of their assets under management. You could, like I said, you can argue with that methodology a little bit. I'm always open to getting people's intake or other ideas or information they may have on the company and or how it could possibly grow itself. But that's the baseline I'm using, which I am also using the 9-year average of their revenues to simulate a very large, significant drop in revenues in the short term. As we had already somewhat talked about, their assets under management have already declined 10%. And I had already mentioned that the analysts are projecting a 14% decline in revenues this year. They're not down 14% already. How much were they down already? Oh, that's right. They're only off of the most recent quarter. I think they're only down about 5% or so. So they're not really down that much in revenues currently. So understand that when I'm simulating a 29% decline in revenues for this year, it's not actually meant to be so much for this year. It's just that my spreadsheet only has really so many levers I can press, because that's the way I designed it. So really, this is, in my opinion, likely to simulate decline in revenues this year. That's probably in line with what the analysts are expecting, maybe about 15%, and then probably maybe another 15% next year or something like that. I expect that they might have a couple years of bad revenues, and I'm just kind of simulating it into 1 year, because that's just the way this particular template is built. And until I make my new template with better levers to press, that's the way it's going to work. So point is either way, I'm simulating a drop down to 5.4 billion in revenues on an expected basis for the next 2 years or so. It'll then climb back up pretty sharply. Worst case scenario at a rate of -2% to get us to that 4.4 billion in the worst case scenario that I had on the projections, and 22% in the best case scenario from that baseline to get us to 13.1 billion or so, which is in line with those numbers that I had projected in my model. So that also using the analyst model, I have that tilted towards kind of the more optimistic side with a 13%, and overall that gets me expected revenues of 8.3 to 8.4 billion or so in 2026, which gets us an expected CAGR over the entire time frame of 1 to 2% on net from 2021 revenues. So that's the projection of revenues that I'm using for the company. Coming down to the net margins, we'll take a look at that as well. I'm also simulating a very, very dramatic decline in their margins in the short term as well, dropping that to the 9-year average, which takes them from a 39% margin to a baseline of closer to 10% for the next year. That will very quickly then grow back up closer to the 30% that they've had in general. So this is a very much a short-term move. And again, you could argue that these very conservative short-term things that I'm putting in here are completely unnecessary, or maybe you could argue that only one of them is necessary or something like that. I'm totally fine with that. This is just me being extra conservative, because I kind of wanted to think about, you know, what's kind of worst case scenarios, especially when it comes to like financial companies. And as I had said at the start, even with the relatively positive valuation I have here, I'm definitely interested in doing more research into this company, because it's frankly got its fingers in so many different areas of finance that you kind of want to, when it comes to financial companies, in my opinion, you definitely always want to take a second look. That's just kind of how I think about it. So either way, the long-term range of the margins that we're going to use, the industrial expectation that they had was close to 15%. So I used that as kind of my worst case scenario, assuming that they basically just dropped down to their industrial average as kind of a worst case scenario. But in the most recent year, they did have around 40% of a margin, which, comparing that to the margins they've had over the long term, which is close to 32%, because like it says, say the 9-year average here, but I specifically actually multiplied that by 0.25 to get the negative effect. I didn't mention that. It's like, that's not actually the 9-year average. That's me specifically manipulating the equation to make a lower number, because I want to make sure I get a low margin in the short term to simulate that negative effects. But moving towards the long term, like I said, the longer term average that they've had over the entire time frame is close to 32%. So I basically kind of went with assuming that they would maintain that average over on an expected basis, 30% being kind of my median case, and then pushing a little bit higher than their most recent margin as the best case scenario. So 15 to 45% is the range I get. On expected basis, about 32 to 33%. So coming down to the sales capital ratio, which is one of the only other major inputs that kind of need to be assumed. As we had shown, that they have averaged close to 1 over the entire time frame, but have kind of been moving downward pretty consistently over the entire 10-year time frame, ending at 0.84. So I think it's pretty reasonable to assume that they're likely to also continue to decline over the time frame, possibly ending closer to their industrial expectation. That's the part that I'm kind of making a little bit of a stronger assumption on, which is to say that like the range, I have it going from 0.25 to 1. And the median case is 0.63. It does lean towards 0.8, but the point is I'm definitely assuming that out of the two of their net margins and their sales capital ratio, I'm assuming that they can keep the really high net margins, but it's their sales capital ratio I assume is going to have to move towards their industrial expectation. It's like I don't think they can really keep both of those as high as they have typically had over the entire time frame forever. And so that's the part that the one part of the numbers here that I think I'm essentially kind of pushing the numbers down a little bit on the one part that I think I can kind of strongly hold the opinion of, that I do think that they
they ought to have their sales to capital ratio move down over time frame. Whether or not they can keep those higher margins and whether or not my revenue assumptions are good, those are the parts I'm definitely less certain about. But the sales capital ratio, I feel like, is a little bit more solid. So with that, with all those assumptions together, we're not really projecting too much for the debt to equity ratio. I'm leaving that pretty close to zero. Worst case scenario, 3%, close to 1.5% is kind of the expected range I have. Like I said, they're about 1% right now. That doesn't really have a huge effect on value unless we make it a much more dramatic number. So really, that's not really a major assumption for this. It's mostly just about the revenues, margins, and the capital ratio that we're assuming. With all these assumptions together, that does get us an expected return on invested capital in 5 years of about 26.5%, which, as we had shown before, they've kind of averaged around 26 to 27% over the last 10 years. So really, we're assuming that they can maintain basically similar returns with these assumptions, which makes me feel pretty comfortable with the assumptions as well. Unless you thought that they were going to do significantly less in the next 5 years than they had over the last 10 years, then these assumptions should be reasonably comfortable, I think, for you. So with that, that makes our entire evaluation complete. The summary page coming over here. Before I get into all that, I will ask one more time, if you are watching either live or on the replay, please give us a like. And if you have not already subscribed to the channel, please subscribe to the channel. That way you can get notifications when we go live and when I release other videos and other content like that. Also consider joining the Discord. The link is in the description below or in the pinned comment for the chat as well. So we have TROW price here, ticker TROW, the US Treasury currently selling for 2.8% or so. It's been moving up a little bit over the last week or two. We'll see if it can maybe retrace up to the 3% line or not. Current market equity risk premium I'm using is 5.29% for mature markets. The discount rate I come up to for TROW price comes up to 8.29%. And the dividend rate that they currently have, not counting special dividends that they may or may not add to their regular dividend, of 3.45%. 5 years ago, they had sales of 4.2 billion, 4.3 billion or so. And the most recent year, it was 7.6 billion, giving them a sales growth of about 5% per year on a compounded basis. Sales to capital ratio for the last 9 years on average has been 0.97 compared to industrial expectations of 0.61. So as I had said before, they have relatively high sales capital ratio compared to their industrial expectations. In the most recent year, it was like 0.84 or so. So it has been coming down, and that's part of the reason I'm projecting that it will likely continue to move downward at least a little bit over time. The returns on invested capital that they've achieved over both the recent short term and the long term, it's been actually pretty consistent for them. It has been pretty close to 26% or so. Debt to equity ratio just under 1%. Default risk, this actually shouldn't be 1%, that should be basically 0%. I just forgot to change that spot there, but their default risk that they experienced over the last year or so was basically about 0%, so that's my mistake for forgetting to change that. Profit margins in the most recent year was 39%, and against their industrial expectation of 15 to 16%. So as you can see, strong sales capital ratio against their industrial expectation and a strong profit margin, which is, like I said, part of the reason why I projected that one of those two things is likely got to change, or at least a combination between the two. Profit in the most recent year, just around 3 billion or so, and they're selling currently for $132.14 per share. The probability distribution that we're using for the company is pretty close to our pretty typical regular distribution, with it somewhat tilted towards our more optimistic fourth model, which is pretty typical for a lot of the valuations we do. With that gives us a sales distribution of anywhere from 4.4 billion in the worst case scenario to possibly 13.1 billion in the best case scenario. On an expected basis, we see 8.3 to 8.4 billion or so, and that gets us a sales growth of anywhere from negative 10.5% per year to possibly positive 11.5% per year. On an expected basis, we see about 1 to 2% on a compounded basis. Sales capital ratio expected, we have about 0.81. As I said, a little bit of a downward move comparative to the longer term average that we're expecting. Returns on invested capital, we do expect to stay relatively consistent in this 26% range or so. Debt to equity ratio, we are projecting that it increases a little bit up to maybe like 1.5%. That's a pretty negligible change, even though technically it's a doubling, but it doesn't really have much of an effect on value, as I already said. And yeah, default risk is basically zero as a result of that. Again, negligible effect on value. Profit margins, we have a pretty wide distribution for the company of anywhere from 15% to 45%. On an expected basis, we see 32 to 33%, which is a definite decrease comparative to the most recent that they had of about 39%, but it does keep them relatively in line with their longer term average, which is what we think makes sense. That does get us a profit distribution in the 5-year forward period of anywhere from 660 million to possibly up to 5.9 billion. In the best case scenario, on expected basis, we see about 2.7 billion or so. And that gets us a present value expected price after adjusting for the discount rate that we are using for the company and the varying levels of the discount rates based off of the various assumptions in the model of $153.87, which is 16% higher than the current share price. And that also gets us 5-year forward value targets unadjusted for the dividends that they will pay out. So that doesn't, you have to subtract out all dividends paid during the period to arrive at the actual share price, but the value target anywhere from $76.44 in the worst case scenario to possibly $493.85 in the best case scenario. On an expected basis, we see $229.14. And comparing that to the current share price of $132.14, we get an implied return for the next 5 years of 11.64%, which is nothing to sneeze at. Definitely pretty good company. I do find a lot very appealing about the company. However, it is not so good of an opportunity that I'm necessarily super interested in adding it to my own portfolio. It does get us to a value score of 0.79, which is not terrible, but definitely not great. That definitely comes off of the back of a pretty wide range of assumptions within the valuation that I have here. So obviously, you know, some of these assumptions some people might find to be completely impossible, though obviously some might argue that other ends of them are just as impossible, though some might argue it more than others. So I don't know, take perhaps whichever model you want to rely on for your own assumptions within it. Definitely don't rely on my research for your own decisions. Do your own research before making your own investments. Anything. As I said, I'm not that interested in valuing this company, but it is a very interesting company, and I'm happy to add it to the watch list. So with that, come back over to our actual watch list and kind of take a look at the companies in the range of where it is. Like I said, this value score of 0.79, which is my own kind of personal number of basically weighing together the expected return, the current amount to fair value, comparing the expected return to market returns, as well as like the best case scenario to worst case scenarios. It's kind of like my own little weird weighting metric that I came up with myself. 0.79 that compares to other companies in the same range as perhaps Walgreens or Intel or Boise Cascade or Skyworks. So it kind of falls into the same ballpark of other companies like that in my watch list as far as that goes. It's worth noting that, like I said, 0.79. Taking a look at the average of my watch list, the average value score that I actually have is 0.57 and the median is 0.61. So it is above average. It is above median. However, one standard deviation and above is generally what I think of as really good investments. And that currently one standard deviation is 0.99. So if you wanted to get an idea of what I thought of as really good investments, it would be stuff in this range right here: Sturm Ruger, Turtle Beach, Smith & Wesson, Hibbett, Fidelity National Financial, and above, so on and so forth. So good company, above average, maybe not so great that it's worth starting a position on. It's basically kind of my take for that. So with that, that's going to basically do it for the valuation today. I am already most of the way through another valuation for an MLP that was actually recommended in the Discord. So if you had any interest in recommending tickers for me to possibly value, not only can you suggest them in the chat here in the stream itself or in the comments after the fact, you can also join in the Discord and have discussions with me directly and trying to suggest companies for me to value. So for example, the MLP company EPD was recently suggested, and I'm working on that as my current valuation. So you guys can expect that to be probably the valuation I'll be doing on Thursday, the next time I stream. I'm also still on the lookout for the annual report for Sandfire Resources, one of the other companies in my portfolio. Their annual report hasn't come out yet, but basically I'm looking to do that valuation as soon as it does come out. And then I have my eyes also on future 10Ks coming out with super microcomputers as well as Micron Technology. So those are other companies that I'm looking to value in the near-term future. I'm not 100% sure which one will be coming next, but the next stream is going to be Thursday as per usual. So with that, that's basically going to be it for today. Like I said, basically assume probably EPD, but like I said, it might be one of those other ones depending on what happens. I'll catch you all again next time. And one last time, please give us a like before you go. All right, I'll catch you all again next time. Later.